Last year, a 68-year-old man ended up paying more than $1,200 extra for car insurance, and he had no idea it was happening. The surprising part is that he never made a single driving mistake. If you're over 60 and still behind the wheel, there's a very real chance the same thing could be happening to you right now. Let me begin by telling you about a man named Jack. Jack is 68, lives in Ohio, drives a 2019 sedan, and has a spotless driving record with no crashes, no tickets, nothing. Jack is honestly a better driver than most people in their 30s on the road. He's cautious, he's patient, he doesn't hurry. And yet, last year, Jack paid more than $1,200 more than he should have for car insurance. Not because he did anything wrong, not because anything in his life changed, but because Jack, like many older drivers, didn't know about one particular thing the insurance industry is very quietly doing and very quietly relying on you not to notice. I'll explain exactly what that is in just a moment. But first, let me give you a little background, because this part matters and it will help everything make sense. So here's what many people don't realize. Car insurance in the United States is not a fixed price. It's not like your power bill, where everyone in the neighborhood pays about the same amount per kilowatt. Insurance companies use something called a risk profile. In simple terms, they review dozens and dozens of details about you. Your age, where you live, your car, your credit score in many states, how many miles you drive, your driving history, and they use all of that to estimate the odds that you'll file a claim. The higher the risk they assign, the higher your premium. That's the basic idea. Now, here's where older drivers get hit especially hard. For a long time, the insurance industry has treated drivers over 65 as a higher risk group, and statistically, they'll point to certain data to explain that. Reaction times, vision changes, certain medicines. Insurance companies use all of that to quietly begin raising premiums as you get older. Now, I'm not saying that's fair. Many seniors are incredibly safe drivers with decades of experience. But that's how the system works. And if you're not paying close attention, your rate can climb by 10, 15, even 20% over only a few years, without one accident, without one ticket, without anything changing in your life at all. But here's the real issue, and this is the actual mistake I'm talking about today, so stay with me. The problem is not only that rates rise. The problem is that most seniors don't review their policy. They set it up once, maybe years ago, sometimes more than a decade ago, and then they let it renew automatically every year. They see the bill, they pay it, they move on. And that habit, that simple habit of not reviewing, is costing them sometimes more than $1,000 a year. Let me explain exactly why this happens. Because it's not just about age-related increases. There are actually several layers to it, and once you understand each layer, you'll start to see how much money could be sitting on the table right now. The first layer is outdated coverage. Think about when you first created your car insurance policy. Maybe it was 5 years ago, maybe 10. At that time, your car had a certain value. Let's say it was worth $25,000. Your insurance agent, doing their job, recommended comprehensive and collision coverage because that made perfect sense for a $25,000 vehicle. But here's the thing. Cars lose value every year. Your car is worth less than it was the year before. And if your car is now worth, say, $7,000 or $8,000, which is very common for a car that's 6, 7, 8 years old, you may still be paying for comprehensive and collision coverage at rates that were built for a much more valuable vehicle. In many cases, seniors are paying $600, $700, sometimes $800 a year for coverage on a car that, if it were totaled tomorrow, would only pay out $6,000. When you do that math, it often no longer makes financial sense. This is something many people don't realize until someone sits down with them and walks through it. The second layer is something called bundling, or more accurately, the failure to bundle correctly. Most people have heard that you can save money by bundling your auto insurance with your home insurance. And that's true. But here's what many seniors don't know. Bundling discounts change over time. Insurance companies update their partnerships, their discount structures, their loyalty programs. And a bundle that saved you 15% 5 years ago might now only be saving you 5%. Or in some cases, it's actually cheaper to separate your policies and shop them individually. If you haven't compared your bundled rate with individual quotes recently, you truly don't know whether you're getting a good deal or not. The third layer, and this one surprises a lot of people, is the senior discount that nobody told you to ask for. Here's what many people don't realize. A lot of insurance companies offer specific discounts for senior drivers, but they don't apply them automatically. You have to ask. There are discounts for completing a defensive driving course, and in 2026, many of these courses are available entirely online, some in just a few hours. There are low-mileage discounts for seniors who've retired and simply don't drive as much as they used to. There are discounts for vehicles with certain safety features. There are loyalty discounts, paperless discounts, pay-in-full discounts. The average senior who actually calls their insurance company and asks, not demands, just asks, what discounts are available, saves somewhere between $150 and $400 a year from that one conversation. That's money available to you right now. But most people never make that call. Let's step back for a second, because I want to make sure this is all connecting for you. We've talked about outdated coverage, incorrect bundling, and missed discounts. But there's one more layer, and honestly, this one may be the biggest of all. It's called the loyalty penalty. And the insurance industry really doesn't want you to know about it. Here's how it works. You might think that staying with the same insurance company for 10, 15, 20 years means you're getting the best deal. You've been loyal. You've paid your premiums on time. Surely they're rewarding that, right? Well, here's the uncomfortable truth. Multiple studies, including research published as recently as 2025, have shown that long-term insurance customers actually pay significantly more than new customers for the exact same coverage. The industry has a term for it. It's called price optimization. Basically, the insurance company's data tells them that loyal customers are less likely to shop around and switch. So they slowly raise rates for those customers, knowing most will simply keep paying. Meanwhile, someone brand new to the company gets a promotional rate that is sometimes 20 to 30% lower for identical coverage. This is completely legal. It happens at almost every major insurance provider in the country. And it affects seniors disproportionately because seniors tend to value stability and loyalty, and they're less likely to go through the process of switching. The insurance companies know this and quietly count on it every single year. Now, I know what some of you may be thinking. Okay, but switching insurance is a hassle. There's paperwork, there are calls, there's figuring out new coverage. I hear you, and I'm going to address that in just a moment. But first, let me give you a real-world example of what this actually looks like in dollar terms, because I think it will make this feel very concrete. Let's go back to Jack. Jack has been with the same insurance company for 14 years. He has a clean record. His car is a 2019 sedan, currently worth about $9,500. He's paying $1,380 a year for full coverage. When Jack's daughter finally convinced him to spend 20 minutes on an insurance comparison website, just 20 minutes, he got quotes from 6 different companies. 5 of them came in lower than what he was paying. The lowest quote was $1,040 a year for essentially identical coverage. That's a difference of $540 a year just from shopping around. And when Jack actually called his current insurance company and told them he was thinking about switching, they came back with a loyalty retention offer of $980 a year, which is still $400 less than what he'd been paying. He didn't even have to leave. He just had to make the call. That's Jack's story. But Jack is not unusual. Financial advisors who work with seniors say this kind of situation happens constantly, with people paying hundreds more than they need to, simply because they never reviewed, never questioned, and never compared. So now, let's talk about what you can actually do about this, because that's really what matters. And I want to give you a very simple, very clear action plan. Nothing complicated, Nothing that requires a financial degree. The first thing you want to do is pull out your current insurance policy or log into your insurance company's website and find three specific numbers. Number 1, your current annual premium. Number 2, your deductible amount. Number 3, the current market value of your vehicle. You can find your car's current market value in about 2 minutes on sites like Kelley Blue Book or Edmunds. Just type in your make, model, year, and mileage, and they'll give you an estimate. Once you have these three numbers, you can start making an informed decision. The second thing you want to do is go to an insurance comparison site. In 2026, there are several good ones. Sites like The Zebra, Insurify, or even just searching for quotes directly through companies like Geico, Progressive, or State Farm. You don't have to commit to anything. You're just gathering information. Spend 20 minutes filling out your details and get at least 3 or 4 quotes. You may be genuinely surprised by what you find. The third thing, and please don't skip this one, is to call your current insurance company before you make any decisions. Just call them and say, "I've been a customer for X number of years, and I've been looking at other rates. Is there anything you can do for me?" That's it. Those exact words. Many seniors feel uncomfortable doing this, as if they're being confrontational. You're not being confrontational. You're being a smart consumer. And more often than not, the company will find some discount or adjustment to try to keep your business. It costs you nothing to make that call. The fourth thing is to ask specifically about senior discounts and defensive driving course discounts. In 2026, AARP offers a well-known driver safety course that, when completed, can earn you a discount at many major insurance companies. Some states even require insurers to offer this discount by law. The course itself is very manageable. It's designed for older drivers, and most people find it helpful and even enjoyable. But the financial benefit is real. Now, I also want to take a moment to talk about something important: scams. Because whenever there's a topic involving seniors and money, unfortunately, scammers are never far away. In recent years, there's been a rise in fake insurance companies and fake insurance agents targeting older drivers specifically. They'll call you, sometimes using official-sounding names, offering unbelievably low rates. They'll take your payment, sometimes even your banking information, and then simply disappear. Or they'll issue you a fake policy that provides zero actual coverage. And you won't find out until you're standing at the scene of an accident trying to file a claim. Here's what many people don't realize. If an insurance rate sounds almost too good to be true, dramatically lower than every other quote you've received, it probably is. Always verify that any insurance company you're considering is licensed in your state. You can do this very easily through your state's Department of Insurance website. It's free. It takes 2 minutes, and it can save you from a very costly and very stressful situation. Also, never give your Social Security number, bank account number, or Medicare information to someone who called you out of the blue offering insurance quotes. Legitimate insurance companies do not operate that way. If someone calls you without warning and starts asking for sensitive personal information, hang up and report it. I also want to mention something about what's changing specifically in 2026 that makes this even more relevant right now. Several states have updated their rules around how insurance companies can use age as a rating factor. There's been growing legislative pressure, and in some states, actual new laws that limit how much insurers can raise rates based solely on age. At the same time, new technology like telematics, that's the little device or app that tracks your driving habits, is being offered by more and more companies. And seniors with safe driving patterns are finding that joining these programs can significantly lower their rates. If your insurance company offers a safe driver program or a usage-based insurance option, it's genuinely worth checking into, especially if you don't drive many miles. And here's the bigger picture, because I want you to really feel the weight of this. If you're 65 years old today and you overpay on car insurance by just $800 a year, which is actually on the lower end of what many seniors overpay, and you drive for another 15 years, that's $12,000. $12,000. That's a significant amount of money that could go toward your retirement, toward your grandchildren, toward travel, toward healthcare, toward anything that actually matters to you. It doesn't have to go to an insurance company that's quietly relying on you not to notice. The good news is that this is one of those financial situations where awareness alone can make a dramatic difference. You don't need a financial advisor. You don't need a lawyer. You don't need to do anything complicated. You just need to spend about an hour, maybe less, reviewing your policy, getting some comparison quotes, and making a phone call. That's genuinely all it takes for most people. So here's what I want you to do after you finish watching this video. Write down these 3 steps somewhere you'll actually see them. Step 1. Find your current premium and your car's current value. Step 2. Get at least 3 comparison quotes online. Step 3. Call your insurance company and ask what they can do for you. That's your homework. It's not difficult, and the payoff could easily be hundreds of dollars back in your pocket this year alone. Before I wrap up, I want to say something directly to the seniors watching this, and to the family members who may be watching this for someone they love. Getting older comes with a lot of financial pressure. Fixed incomes, rising healthcare costs, inflation. Every dollar matters more than it ever has. And the frustrating thing is that so many of the financial systems around us, insurance included, are quietly set up to take advantage of people who trust them and don't ask questions. That's not okay. And the single most powerful thing you can do is stay informed. Ask questions. Review your bills. Don't let loyalty become a financial disadvantage. Jack got his $540 back. Not because he was lucky, not because he had special connections, because he took one afternoon and paid attention. You can do the same thing. Don't leave money on the table. Share this video with a parent, a grandparent, a neighbor, or a friend over 60 who drives a car, because chances are very good that they're in exactly the same situation Jack was in. And if this video helped you in any way, leave a comment below because I read every single one. Stay safe out there. Take care of yourselves, and I'll see you in the next.